Welcome to Spotlight Knowledge. I am Jennifer. Spotlight Knowledge uses easily understandable methods to teach you knowledge in finance and investment. We help you develop skills you need and prepare you for a rapidly changing world. Today's spotlight is on modern-day Cobra effect. First, we need to know what is Cobra effect. The term Cobra effect is used to describe a situation where the solution to a given problem actually makes the problem worse. It is commonly used when talking about the unintended negative consequences of government policies. Sometimes, well-intentioned solutions can make matters worse. The term came from a British policy implemented in India during its colonial rule. There was an extremely large number of cobra in Delhi. British were worried about it. In order to curb the cobra population, they announced a policy that offered a reward for dead cobras. At the beginning, this was a successful strategy. A lot of snakes were killed for the reward. But soon, in order to make more money, some enterprising Indians began to farm cobras. They bred cobras, killed them, and turned them in for money. When the government became aware of this, they were very angry. Annoyed by the abuse of policy, they canceled the reward program. So now the breeders were stuck with a lot of worthless cobras. What could they do about them? They soon released them in the wilderness. Then the wild cobra population further increased. So, a government policy intended to curb cobra population in Delhi, in the end, ironically increased the population. This is how the cobra effect was born. Charlie Munger once said, "Show me the incentives, and I will show you the outcome." Incentives affect people's choices and behaviors. All human beings' behaviors can be explained by incentives. The effects of incentives could be positive or negative. It's not easy to design incentives that do not have negative consequences. The Cobra effect occurs when the consequences worsen the problem the incentives tried to fix. With the government and central bank's intervention in the economy and markets, Cobra effect has experienced a revival. It is becoming quite prevalent. Let's look at two examples where we might be seeing it in action. First, let's look at bailout. When the government bails out a big company, presumably it does so with good intentions, such as saving jobs, preventing the company from posing systematic risks to the entire economy. But the bailout may have other unintended consequences. Executives in other big companies may take the bailout as too big to fall. And meanwhile, they may think they are playing with house money. They won't get hurt, no matter what happens to their companies. We know executives are compensated on the basis of shareholders' returns. So, if their company takes more risk and more money for shareholders, they will get more benefits too. Why not take on additional risk if government has your back too? So, the seemingly well-intentioned government intervention may lead to more risk-taking, causing big companies to have more debt. We know highly leveraged companies are financially vulnerable when a bad event or crisis happens. These companies can easily collapse. This actually creates more pressure for bailouts. What will the government do then? Now let's move on to the second example, monetary and fiscal policy. Because of the COVID-19 pandemic and quarantine, the global economy has been struggling. Governments around the world have been undertaking aggressive monetary and fiscal policies, trying to stimulate their economies. But the typical government actions, such as lowering interest rates, QE, and direct stimulus, may have painful unintended consequences. The cheap new money may seduce companies to take huge loans, to irrationally expand their businesses, and invest in speculative financial markets. Meanwhile, the extremely low interest rates may seduce individuals and families to take a large loan to buy luxury houses in the already overvalued real estate market in order to fulfill their expensive desires. The flow path of the new money through the economy easily leads to speculative bubbles in financial markets, such as real estate bubble, commodity bubbles, and stock market bubble. What matters in a bubble is market psychology, not valuation. Valuation is irrelevant. That's what makes it a bubble. Only when the tide goes out, you discover who has been swimming naked. Bubble will eventually end up in painful bursts. In a difficult situation, highly leveraged companies are extremely fragile and easily collapse. Meanwhile, highly leveraged individuals may lose their jobs. If they cannot pay their mortgages, they will soon lose their houses too. All of these will trigger liquidity crises in the economy. You can imagine how messy the economy could be. Monetary policy intended to help economic recovery actually makes the economy far messier and create more pressure for additional bailouts. Not to mention that the increase in government debt undermines currency credibility, and the new money through the economy benefits the wealthy people more than poor people, increasing economic inequality. When the rapidly increasing economic inequality are combined with social issues, violent conflict is most likely to arise. George Floyd's death-related looting and armed conflicts happening in the United States are good examples. That's all for today. Thanks for watching. Please like and subscribe for more videos.